Digging into the housing market, the shelter index rising 0.4% in January from the month prior. That is according to the Bureau of Labor Statistics. Overall, housing costs are up more than 4% from last year. We have seen mortgage rates ease 3 weeks straight, boosting mortgage demand this past week. Applications rising 2.3% and the finance index rising 10%. But overall, inflation came in a bit hotter than economists expected in January, and that's pushing traders to reevaluate the timing of rate cuts, potentially putting mortgage rates at further risk. Full circle here. So, here to break it all down, we've got Logan Mohtashami, who is the lead analyst over at HousingWire. Great to have you here with us as we're continuing to take a look through all of this data. First, your reaction to what CPI is telling us and how that could inform the Fed and thus inform mortgage rates as well.
Well, traditionally, the CPI data tends to be hotter the first few months of the year, just like it was last year. And then people start talking about maybe rate hikes, and then the disinflation, especially from rents, tend to happen toward the middle and second half. I believe that's what the Fed is really counting on happening. The Fed has their own current BLS index that they track, and that actually went negative recently. So I think there was a lot of optimism that shelter, which is 45% of CPI inflation, would come in a little bit cooler than it is. It didn't, so the 10-year yield gone up, which means mortgage rates go up as well.
And so within all of this, as we got some more of the mortgage refinance demand data here this morning, is it appearing that there is going to be a new sweet spot that emerges to get more refinancing applications, especially as some of those who are sitting on lower mortgage rates right now are sitting pretty, quite honestly?
I mean, 82% of the country have rates 6% or below. So it's a very slim pickings in terms of rate and term refinances. Generally speaking, over the last 3 years, when mortgage rates head towards 6%, the housing data gets better. And even though the growth rate of inflation has fallen from the peaks, mortgage rates are still been elevated. They were elevated before this report came out. To me, the labor market matters more to the mortgage market and to the housing market than inflation. We've made great progress on inflation on a year-over-year basis. It hasn't done anything for rates in any meaningful way. But if you get towards 6%, then you have better housing data, of course.
And so with that in mind, where will that also spur some of those potential new entrants into the home buying market?
Yeah, you know what? Most sellers are home buyers as well. Mortgage rates heading down towards 6% can get more new listings and you can get more demand off of that. But I haven't seen anything in terms of the housing market performing well when mortgage rates are between 6.75 and 8%. Now, 8% was something that happened in 2023. Mortgage spreads were bad back then. They have improved in 2024 and 2025. I tell everybody mortgage rates could be a lot worse today if the mortgage spreads were as bad as they were in 2023. So that's the only grain of salt I could give on a positive side for mortgage rates. But really, the labor market has to soften up for the bond market to go down and for mortgage rates to go down for it to be anything meaningful for the housing market.
Logan, while we have you, on another note here, Fed Chair Powell testified in front of the Senate yesterday, and he spoke about the impact of climate disasters on the housing market, particularly insurance companies. I want to play this short clip and then get your reaction on the other side.
We're seeing the same thing, which is both banks and insurance companies are pulling out of areas, coastal areas and things like that, or areas where there are a lot of fires. So what that is going to mean is that, you know, if you fast forward 10 or 15 years, there are going to be regions of the country where you can't get a mortgage, there won't be ATMs, there won't, you know, the banks won't have branches and things like that. Right. That's a possibility coming up down the road.
And so if you do have areas 10, 15 years from now, as Fed Chair Powell was saying, that mortgage rate companies, or not mortgage rate companies, insurance companies deem uninsurable, how does that really spur some of the housing market demand or shifts?
So we talked about this on Yahoo Finance early in 2024, that there's going to be parts of the U.S. that home buyers won't want to live or can't, right? If you don't have mortgage products available, literally, or insurance products available, you won't be able to get a mortgage. It has to be an all-cash market. That is not a functioning housing market. And especially if Freddie and Fannie are out of conservatorship and become publicly traded companies, again, that process can accelerate faster than 10 to 15 years. So this is something that all of us are going to have to deal with. I'm hoping at some point in the future, The private sector, state, and federal government figure out a solution, or there's simply going to be areas that cannot be insured. If you're not insured, you're not going to get a mortgage. If you're not can't get a mortgage, it's a cash buyer's market. That is not a functioning housing market. You would have to look in parts of western parts of Florida, parts of California, out there, and I think that's something that eventually we have to address, but it doesn't look like anybody wants to take the lead on this yet.
Logan, thanks so much for taking the time, helping us break this down today. Really appreciate it.